Hello and welcome. I saw a headline today about Berkshire Hathaway and its portfolio declines that it's experienced recently. So I thought I'd just take a minute to look into this a little bit and share with you just a couple of thoughts about this. So as you might know, Berkshire Hathaway's largest portfolio holding is Apple. So this Seeking Alpha article references a Barron's article that was published recently. And if you haven't taken a look at Seeking Alpha, I highly recommend it. It's a great resource for investors. So here Seeking Alpha has highlighted the losses that Berkshire Hathaway has experienced, at least the top holdings that it has among the top holdings. So you can see here, compared to the S&P 500, you can see Apple and Bank of America, also a very large holding for Berkshire Hathaway, Coca-Cola, as well as American Express, all of them declining over the past few months. But interestingly enough, Coca-Cola not by very much. So let's take a look at a few of the fundamentals for Berkshire Hathaway to see if this is some kind of a meaningful decline, if it's worth actually buying at this point, if it has declined enough. And then we can take a look at Apple as well and see some of their fundamentals and sort of see how those two companies and two publicly traded businesses play against each other. So this is the main page for Berkshire Hathaway on the Guru Focus website. Guru Focus, as I've mentioned in the past, is my favorite tool for doing fundamental analysis, stock research. Check out the link below if you're interested. One of the newer features which I really like is the GF value or Guru Focus value chart that they have added. So there's a few calculations that go into this, but you can tell based on this chart that Berkshire Hathaway has fallen below what Guru Focus has calculated probably to be its intrinsic value. It seems to be somewhat accurate, especially if you look at some other metrics. I won't get into the details about how they calculate this number, but for many large, high-quality businesses and profitable businesses, especially with a longer track record, this does seem to have some accuracy and might be worth looking into more, especially where you need it to add to your decision-making to buy or not. So here, Berkshire Hathaway actually has fallen almost 23% from its most recent high. It had gained a lot since the 2020 decline at the beginning of the pandemic, again heavily influenced by Apple as its largest holding. Now, it's important not to forget what Berkshire Hathaway is. Obviously, it's a very unique company when you look at publicly traded investments. Berkshire Hathaway obviously led by Warren Buffett for decades, and a lot of its value comes from his track record and his knowledge, as well as that of Charlie Munger. You might also think about it as a conglomerate because Berkshire Hathaway itself owns dozens and dozens of companies, some of them entirely, and many companies like Apple it owns a piece of, where that company remains publicly traded. But insurance is still a very large part of what Berkshire Hathaway does. And that side of the business isn't going away anytime soon and continues to add, especially to the cash pile that Berkshire Hathaway holds, giving it its ability to buy more stocks or to do buybacks, which it has been doing a lot of recently. Knowing that Berkshire Hathaway has been doing a lot of buybacks with its cash also adds a lot of value to some investors because they like the fact that the cash will be deployed to purchase outstanding shares, and there can be a tax-free gain from that capital appreciation that takes place when Warren Buffett reduces the number of shares outstanding. So this is the page for Apple, again at Guru Focus. This is the summary page. Again on the chart you can see that Apple has declined fairly meaningfully from its most recent highs, also by almost 23%. But again, according to the GF value, Guru Focus is hinting that Apple might be undervalued at this point. Now, I'm not going to get into a full analysis of Apple at this point, but you can see there are quite a few green points, especially when it comes to profitability. I've discussed Apple in the past, and it's no secret that selling iPhones and all of the other products that Apple offers is very profitable and has been profitable for quite some time. At least as far as I'm concerned, Apple appears to be a very high quality business and one of the prime examples of a company that is in a place to be a market leader for many years to come. On the other hand, there are a lot of people speculating about the future of the economy A lot of people have been talking about things like inflation and increasing interest rates, and rightfully so. If worries about decreased spending and a slowdown in the economy and a possible recession actually come to pass, then certainly it is conceivable that less people will buy iPhones, less people will spend money on all of the things that generate revenue for Apple, while at the same time, Apple has to figure this out and continue to pay all of its expenses, therefore completely changing the calculation of Apple's expected earnings and revenue for the foreseeable short-term future. So with a PE ratio of around 23 or just under 23, some could argue that this number could be affected by any decline in earnings because obviously the PE ratio will directly change in relation to earnings. So a decline in earnings will change that ratio. On the other hand, if you don't think that Apple's earnings will be affected too badly, at least not in the long run, and you feel there still is lots of runway left for growth with Apple, then you might decide that this is actually a good point to buy Apple to add it to your portfolio if you believe that it is undervalued at this point and you plan to hold it for many years. All right, I hope you found this interesting. Have a wonderful day, and bye for now.